So I want to give a congratulations to anyone who has weathered this market. By the numbers, the first half of 2022 has been the worst performing market in 50 years. And the latest market sell-off, I began to again look closely at what's been an amazing company the last few years and has recently performed a 10-to-1 stock split. For any investment, let's think about potential returns. Can this investment significantly increase over the next 5, 10, 15 years? Well, remember the investing bias. The best stock to buy might be one already you own, which means when deploying capital, I look at all my companies and some comparisons before starting a new position. Shopify is an amazing brand, but can they continue to grow and create value? 10% of e-commerce in the US flows through them, through 2 million stores on the platform. Amazon is our largest competitor in the space by far. They've been making significant investments into distribution, which has been a huge cost to the business. But doing this, Shopify Fulfillment Networks is now able to provide 2-day shipping in 90% of areas. So what else does Shopify do? So unlike Amazon, you don't go to Shopify.com to browsing and buy goods. Shopify is a platform that e-commerce is built on. And they make money as the businesses using their platform succeed. And this drives them to continue innovating to provide additional and better services. Through Shopify's tools, an individual or large business can create an e-commerce website. From there, you have access to multiple tools to find customers, drive sales, and manage the day-to-day operations. They have also entered the POS system market and have also started a buy now, pay later partnership with a firm through ShopPay. ShopPay is a sales system for e-commerce that is designed to increase the checkout speed by 4 times by saving shoppers information. This helps businesses by increasing checkout order by 72%. But it's also for physical retail, so as people leave their homes to buy at the physical retailers, Shopify can capture a portion of that market. Recently, Shopify has said they're transitioning from more direct-to-consumer to the future, which is connect-to-consumer. In the latest Shopify editions, Shopify is showcasing tons of new tools geared towards shops connecting with their customers, finding customers, converting shoppers to buyers, building your brand and relationships, running the business, and ultimately scaling it. Some examples below is they've built a tool called Shopify Audience to increase ad performance and find new best customers for your business through smart audience creation with machine learning. Shop Cash will give buyers Shop Cash rewards and offers to users with Shop Pay and promises higher conversion rates. Shopify's new Planet app gives businesses using it the ability to easily ship carbon neutral. And Twitter Shopping is a new partnership to highlight your products on your Twitter profile and sell your products directly through it. So let's talk stock performance. Like many stocks, Shopify is down significantly from all-time highs and is down approximately 75% year to date. But Shopify's growth has also appeared to slow the last 12 months, with last quarter's revenues declining and negative net income the last 2 quarters. They try to continue expanding the business. They also showed a gross profit of $637 million on $1.2 billion in revenue, but this was quickly eaten away by marketing and R&D costs of over $600 million. These have been increasing substantially every quarter, ultimately making operating income to be negative by $97 million last quarter. While new initiatives by the company sound promising, it's yet to be seen if the money spent is going to provide a strong ROI for shareholders. Insiders have also been net selling for the last year. However, in the last month, CEO Tobias bought $10 million worth of shares after being a net seller last year. This is a bullish indicator as he most likely believes it's currently undervalued. Also, hedge fund holdings have increased recently and analysts have an average rating of $75 per share, which is an 86% upside from today's current price of $40 Canadian. So comparing it to Amazon, which is down 37% year to date, it's also showed signs of slowing growth in the last 12 months. However, unlike Shopify, Amazon's operating income continues to be positive, and I think it accelerated a lot if they decide to decrease spending. Insiders again have been net sellers for last year, and we see little to no buying from inside the company. Amazon has also recently completed a stock split, which enticed some newer investors to buy the company, and analysts have a consensus stock price target of $178 per share, which is an upside of 62%. This is versus 86% upside with Shopify. So lastly, looking at valuations and cash flows, I do believe Amazon is still the better deal in the e-commerce space. but is less growth potential. However, this lower growth does give you less risk on the whole of the business. So with Shopify, the trailing 12-month earning per share of 14 cents, it's currently trading at a very high PE. With that being said, I am willing to wait to possibly enter a position later in the year on the possibility that they could be available at an even better price in the coming months, or they show a reversal in the earnings trend, indicating they can flourish once again post-COVID. I do think they will eventually succeed, however, so I'll be watching closely for costs and earnings to stabilize. Also, as a small cap investor, I must also compare with other small caps in my portfolio. Small caps were hit harder and sooner than large caps, and potentially when we get to a period of risk on again, which would be when we have signs of inflation decreasing and a war in Ukraine ending, small caps are historically faster to recover again than the large caps. Comparing it to my largest holding, Tenet FinTech, if I were to make a significant investment in either of these companies, I would most likely trim my position and tend to do so, provided they can 2x their revenues and increase gross margins this year. Tenet also feels like they're very much at the bottom, as they have significant catalysts on the horizon. In the coming weeks, they're going to report on 6/18 shopping event, and then we'll get Q2 financials in August. With a TSX listing around the same time, the short-term catalysts for the company right now are promising. So if we get good numbers and inflation appears under control, I do think it's possible they could reach a 500 million plus market cap by the end of summer. So as everyone looks for opportunities when stocks are struggling, I think Tenet still provides a better potential return this year over Shopify, as I still have high conviction in the company, but will look for an opportunity in the future as outlooks or valuations of companies change. More and more, when I look at the large caps, it does get more interesting and something I am considering. But I think this is not the end of the drop for Shopify. But again, we have to wait for future quarters of results to know for sure.